Hello, everybody. It's Gerry Scott here from the Snowbirds Expat Radio Podcast. And we are recording today we've got all the bases covered. We've got Maui, we've got Calgary, and we've got our producer, Mike, from Toronto. So today's podcast is really going to be geared towards that Canadian moving home or the Canadian moving home or American coming up to Canada. And today we have Tony and Cindy from CompassTAX in Calgary. And welcome to the show, and tell us a little bit more about yourselves and what you do. And then we've got 6 very technical questions that I'm going to try and ask Tony and Cindy. So go ahead, tell us more about CompassTAX.
CompassTAX has been around since 1990. And we specialize in cross-border tax, U.S. citizens living in Canada, as well as multinational companies that send their employees abroad. So we deal with a lot of cross-border issues that seem to be coming up more and more with each passing year, especially with global mobility, people being able to work remotely. So a lot of this has come up quite a bit, and a lot of U.S. citizens that are renouncing citizenship or require assistance with their U.S. taxes. As we all know, they have to file on their worldwide income regardless of where they are resident. So we do have many U.S. Citizens living in Canada that require our services. So it's been a great challenge and very interesting work. And Cindy here, our senior manager at CompassTAX, has been actually with CompassTAX longer than I have been. So she's well versed in the U.S. taxation and cross-border tax. So I'm glad she could join us today, so she can tell a little bit about herself, and we'll get into it.
Yeah, sounds good. So as Tony mentioned, I'm a senior manager here and definitely specialized in U.S. taxation as well as Canadian taxation for individuals. And I think we're both, CompassTAX is a CPA, a Canadian CPA firm, and been doing this type of work, I think both of us, for quite some time now. Yeah, going back to the early 2000s.
Now, we always have to ask the question, this is a Canadian question. How far is your office from the rink where the Calgary Flames play?
Long walking distance, I would say. Not too far. We're on 8th there. I would call it 12-ish blocks.
Yeah, 25 minutes, 30 minutes. I don't know. I know people have done it.
I've walked it, yeah.
Well, little inside story. I have a brother that lives in Calgary, and of course, I'm a big Vancouver Canuck. We've had the opportunity to work with a few of the Canucks over the years, and I lost a $5 bet to him the other day. So your Calgary Flames beat Vancouver 5-2. So let's jump into the questions here, and I haven't paid him yet, so but I'm good for it. So the questions we have are going to be really geared towards the Canadian coming home or the American moving up to Canada here. So one of the first questions I have is, what do U.S. citizens moving to Canada with a Roth IRA? What do they need to do?
All right. So I'll just address that one. So I wanted to mention firstly that many people, when they come to Canada, whether they're returning or coming for the first time moving to Canada, they don't let their accountants or other advisors know about their Roth IRA accounts. They kind of assume that because they're non-taxable for U.S. purposes, that they're also non-taxable for Canadian purposes. And so even when this information is requested about their various financial accounts, some individuals might not provide this information, and it can be quite a costly mistake. So just in terms of the taxation for Canadian purposes, Roth IRAs, the income would generally be taxed on an annual basis. But however, under the U.S.-Canada tax treaty, there's a provision to defer the taxation, the Canadian taxation, provided no contributions are made to the Roth IRA while the owner of the account is resident in Canada. So that election is very key. So in order to claim that treaty provision, there's an election that does need to be filed in order to defer the taxation of the Roth in the Roth IRA. And so this election, the due date is generally the due date of the individual's entry tax return. So that's normally April 30th of the year after the individual becomes a tax resident of Canada. And so the election is required for each Roth IRA account that's held. So there could be multiple elections needed. And provided the election is filed, Canadian information filings such as Form T1135, the Foreign Income Verification Statement, the Foreign Trust Forms T1141 and T1142, and the Foreign Affiliate Form T1134 aren't required to be filed. So that election, as I mentioned, is important, as well as ceasing to make contributions to the Roth IRA, and that ensures the Canadian tax treatment matches the U.S. tax treatment.
Now, this is a great opportunity because this came up today in our office. When an individual, they're 59 and a half years of age, they live in Canada, they got their Roth IRA with a good advisory team that can manage both sides of the border. When they take money out of their Roth IRA, how do they report that income going forward, or does it need to be reported if they take it out?
So as long as that election was filed, that Roth IRA is then basically viewed as a pension for Canadian purpose. It's viewed as a pension, but under the tax treaty, if the pension is not taxed by the U.S., it also results in that same taxation for Canadian purposes, so non-taxable for Canadian purposes as well. So when provided everything is done correctly, there is a treaty treaty provision that covers both the current taxation of the income earned in the account, as well as when it's cashed out, there would be no subsequent taxation on the withdrawal.
So there's no forms they have to file if they take the money out of the Roth IRA, providing they're a certain age?
No special form. There is the option potentially to include the income and exclude the income because you're claiming a treaty provision. But I think most of the time it's generally just excluded.
And you might not know the answer to this question, but what happens with some of these U.S. institutions in the States when you move the Roth to them, and they have this 5-year rule, because it's hard for them to keep track if it's going to be a qualified withdrawal. But what we're finding is that because within a 5-year time frame, some of these institutions will hold back a percentage, and then you have to file a form to get it back. Have you come across that at all?
So there could be potentially the U.S. tax filing that could be.
That's exactly,
yeah. To get that tax back, because as long as what is in the Roth IRA account is all, like you had mentioned, qualified amounts that qualify for the non-taxable treatment when it's withdrawn, then you could file that tax return, that U.S. tax return, to get that tax withheld back. Okay.
Well, moving along, like you say, the big takeaways with the Roth IRAs is that when you move to Canada, it's within the next filing with CRA that you have to file that election to let them know that this is a Roth IRA and no future tax obligations going forward if you withdraw money. So that's very important with the IRAs. So here's another question, and this is more around and this is a bit of a problem for Americans moving up to Canada here. We've experienced this. And today I'm your host. I'm not the financial advisor, portfolio manager, so I'm going to pretend this is all new to me and I don't deal with this stuff on an ongoing basis, but we do. So the question is that 529 plans, what can these Americans do with these 529 plans when they leave United States and they move up to Canada here?
Yeah, so these plans definitely can be problematic from a Canadian perspective. So there's no exemption or deferral of Canadian tax on the income that's earned annually in these plans. The one good thing is there normally should be a step up in the cost basis when the individual owner enters Canada and becomes resident. but other than that, there's some other considerations that need to basically be reviewed, because it's thought that many 529 education plans may be considered a deemed resident trust in Canada. And so that would require Canadian trust tax filings, which would also include Form T1135, the foreign income verification statement. So there's no definite position with CRA regarding these 529 plans. And so it's definitely important to review the 529 plans that an individual holds, and in particular with new Canadian trust reporting rules that are applying for T3 trust returns. And these rules basically apply for year ends that end after December 30th, 2023. So the new rules basically kick in for December 31st, 2023 year ends. And penalties can apply where these trust tax filings are not filed with CRA. So one consideration that an individual may wish to do is that they may want to transfer the ownership of these 529 plans before entering Canada. And then as well, just a quick point that later on, when the children, if they still are remaining in Canada, they may have reporting on those distributions when they're later taken from the plan. But,
so let's say that Canadian family moves up and they've got some kids that are under the age of 17. Are they going to be able to set up RESPs for these kids, or do you kind of go against Americans owning RESPs, or maybe?
They are problematic from the U.S. side, in that the income earned in the RESP accounts is taxable for for U.S. purposes, and so that has to be factored in. Basically, is that currently under the tax treaty that's in place, there's no exemption on the U.S. side for, there's no recognition of kind of a deferred tax treatment on RESP income. So kind of both our 529 plans, are definitely kind of an issue on the Canadian side, and the RESP plans can be an issue on the U.S. side. But on the U.S. side with the RESPs, at this point, the view is that they're not required to file the foreign trust reporting forms, but the income is reportable.
Now, we've talked about this a lot. The tax treaty has not been visited for years, and hopefully soon, because I know that the last time it was the treaty between Canada and the United States, they need to include RESPs, they need to include TFSAs. I mean, none of these things were part of that treaty. So hopefully that does, somebody important from Calgary can motivate somebody to revisit this treaty. Okay, so here's the next question, and this might be for Tony, it might be for Cindy, but we're coming across very few advisors that are licensed in both Canada and the United States. And how important is it to have that advisor that can work with a firm like Compass when it comes to investments on the U.S. side and on the Canadian side? And I don't know who's going to answer that, if it's Tony or Cindy, but go ahead.
Yeah, I'll touch on that. Thank you. I think what we often find when we interview a client, we have a quite comprehensive organizer to at least best address what type of assets and or investments they hold on each side of the border. So we're able to work with them and give them the advice needed, or give them advice to talk to their broker or someone that can deal with both sides of the border or transact on both sides of the border. Because we often find that an individual, whether they're mostly it's if they're a U.S. citizen and they come to Canada, they often run into a situation where they come to us subsequent to becoming a resident, and some of these things have already occurred where retroactive tax planning can't obviously take place, but they may not give them an option to transfer funds or assets into another type of account, or they're not able to deal with a tax resident of one country or the other. And we often even see that when a Canadian does go down to the US as well. So being able to work with an advisor that is licensed to trade or operate certain investment accounts, registered or non-registered accounts, it gives them access to have more flexibility to deal with those assets in the most tax efficient manner. So that then from a tax perspective, CompassTAX can come in and give them the proper advice on what they can or should not do, and then be able to coordinate with an investment company that can trade on both sides of the border, because that is only going to be best, the most efficient way, tax efficient way of handling their accounts. We currently even have, unfortunately, a horror story in the sense where we have a client where they moved to Canada. They are U.S. citizens. They advised the brokerage firm that they moved to Canada, and they provided them with their Canadian mailing address. And unbeknownst to them, they closed the account and issued her a check within 5 days. She didn't have time to do any type of trying to correct or move monies around between her accounts. And the issues that, for example, with the Roth IRA that Cindy spoke to earlier, there's penalties obviously if you're under 59 and a half and you withdraw them. And being able to be more proactive and being able to move the money, or contacting the financial advisor that either works with the cross-border tax account or contacting us prior to the move. It's really imperative to be able to minimize any penalties that could also occur with the liquidation of their portfolio.
The other thing that I've had an opportunity to meet with a few mutual clients, and the importance of having Tony and Cindy on the call and ourselves. And now we're also finding that, having that third person, may it be a immigration lawyer on the call. I mean, we're all thinking questions out loud, and the client becomes a little bit of a spectator, because Tony's brain is moving along, and he's got questions for me, and I've got questions for Tony. So the importance of not only working with a cross-border advisor, but making sure that you have a cross-border advisor that has a great relationship with CompassTAX or immigration firms, so that you can have that meeting of the minds. I can't stress that enough. Now, the other question that really comes up quite often is, as charming as these Canadian advisors are, they don't understand PFIC. So let's touch base about PFIC for the next couple of minutes here, or hours, because it can go on for a long time.
Yeah, this topic could be its own podcast in itself, but I'll let Cindy touch on some of the pitfalls of PFICs and what they are, and some general advice on that. So I'm going to hand it over to her now.
Yeah, so basically PFICs are passive foreign investment companies. So generally Canadian mutual funds, Canadian exchange traded funds, and index funds are normally considered PFICs for U.S. purposes. And we don't normally recommend U.S. persons that move to Canada that they purchase or hold these funds, as they're taxed punitively for U.S. purposes. So basically, Canadian tax advantages of mutual funds are not allowed for U.S. tax purposes. In addition, there's annual PFIC filings that are required to be filed for each mutual fund. And generally, these extra compliance fees of completing the annual PFIC 8621 forms, in many cases, it outweighs the benefits of owning the funds themselves. And then as well, it can be challenging to obtain the necessary information to prepare these forms. So basically, we just want to say that they're not recommended other than potentially in Canadian RRSP accounts. So with the IRS, they don't look to the underlying assets in the registered retirement savings plan. So funds in there can be okay, but elsewhere, any other type of account, basically, it's not recommended because of the tax treatment and the tax filings that are required by the IRS.
Regarding this PFEC, we do these lunch and learns, and we try and explain around the issues of PFEC. And we started doing lunch and learns with some of these Canadian advisors, and we've never had so much pushback that these advisors think it's okay to file 8621s for every account, or the QEFs or whatever. They say, not a problem, not a problem.
Yeah.
And I'll tell you, it is, these are colleagues. It doesn't matter what firm you work for, but here's a national firm, been around for 100 years. I won't name any names, based out of Winnipeg. We did a presentation with them, and we tried to educate them on a PFEC. And they said, well, we've got a solution. We have a fund of funds. I went, okay, well, you still have to file a PFEC report. So a fund of funds, instead of having, 10 funds in a person's portfolio, it's now under one entry and only one 8621. And that's their answer. This young advisor, very intelligent, said, I can challenge you on PFEC. I went, well, not really. You got to avoid PFEC unless you understand the filing that a U.S. person has to go through to be compliant. Anyhow, it was interesting to see this young, intelligent, very charming advisor wants to argue with us about PFEC. So next time I'm going to get Tony and Cindy on the call with them, and we'll take it from there.
Yeah, once we explain to the client how much each 8621 form cost to prepare. Obviously, we're not here to discuss fees, but just to say that it's quite an expensive venture to have a handful of PFECs within your 1040 tax return. And just to speak in general terms, I often indicate to our potential clients or current clients that have a handful of PFECs that the PFEC reporting will cost more than the preparation of your tax return in itself. And then the alarm bells and the lights start going off, and they go, okay, that's generally all the taxpayer needs to hear.
And sadly, it's such a simple, it's so easy to avoid. PFEC, don't own Canadian mutual funds or Canadian ETFs. And there's alternatives. But we can't disclose all our fees, and we can't give away all our secrets on the podcast. So so the next question I have for you is, when a U.S. person a Canadian person leaves United States, and we know that there's rules that they want to renounce, but let's say that a green card, when you surrender your green card, that is a form of renouncing. You no longer eventually have to file U.S. tax returns. So the question is when they move from the United States to Canada, how do they keep track? What is the exit and cost base and all these things they have to keep track of? And I'll pass it over to Tony.
Yeah, and I think what I wanted to really touch on some of these cost base and investments is, and I know we're geared more towards the U.S. side, but there was a lot of what I really wanted to touch base on this question about what the cost base of your investments are is, when I wanted to touch on where taxpayers are coming from a low taxing jurisdiction or a non-taxing jurisdiction in the cost base. Now, I know that, a lot of what, we're talking about today is US based, but there is also a large component of what needs to be considered, even if you are coming to Canada and you're not in the US. And I really wanted to touch on it from a non-US perspective, if that's okay. Okay.
Go ahead.
So when you're coming from a foreign jurisdiction, in general terms, your assets are recognized, the cost base of those assets are recognized at the fair market value of your date of entry into Canada. So we often see that individuals are often reporting the sale of their assets or investments and using their original purchase price, not taking into account that they need to be recognizing the cost base of those assets at the fair market value and their date of entry into Canada, not their original purchase price. So we often see that on first-time residents, unless they've entered Canada a second time, which we'll get into that topic. But we often see that missed, and again, that's the importance of it, of obtaining proper tax advice, so you're able to potentially minimize your taxes, because a lot of the times, not in all circumstances, but most of the time, these individuals' investments are winners, not losers. So they're essentially paying more tax than they need to. As well as we mentioned, the first-time residents of Canada have a Form T1135, which Cindy touched on, which is a foreign verification statement. It's not applicable if it's the first time you've entered Canada, but this is where a lot of individuals get lost on, is that the second year of residency, you're required to file that Form T1135, and there are quite a few that miss this. It is a form that's required to be filed with foreign assets that have a cost base, not a fair market value, greater than $100,000. And this form does carry a maximum penalty of $2,500 for non-compliance, which is calculated at $25 a day for up to 100 days.
You know, and here's going to be my last question before we wrap things up here. I find that the firms in Calgary it's almost like we were jokingly, before we came on the air, we were arguing, is Maui the center of the universe? Is it Toronto? Is it Calgary? But how did Calgary get so good and so far ahead of the rest of the country when it comes to U.S. cross-border tax? Like, what is Calgary? I think I know the answer, but I want to hear it from you two. How did you guys become so good at what you do?
Well, I don't know the exact number, but I think in Calgary alone, what's the number of U.S. citizens living in Calgary and/or the Calgary area?
Yeah.
Am I correct in thinking it was around 100,000, or maybe I'm misremembering? But there is such a large number of U.S. citizens living in the province of Alberta. And obviously, even to this day, many of them are unaware that they need to continue filing U.S. tax returns as citizens, because they're no longer resident there, or they have no U.S. source income, so they think they don't need to file. So I think with each passing day, through podcasts such as this, or the media in general, they're becoming aware of this. And with such a strong population base of U.S. expats living in the province, it has definitely been an area where the expertise is needed. We've been able to provide it, and CompassTAX has been around for, as I mentioned, since 1990. So it's been an area that we've been able to grow with, and a name that a lot of individuals and/or cross-border clients have even word of mouth have been able to refer them to us, because they know what we can do for them. I think another reason, as well as us being able to facilitate this, and is that we've been dealing with, as part of our services we provide with assignment tax programs, is what we like to tell them, are global mobility employers in the oil and gas industry, and specifically where a lot of individuals are going back and forth between Canada and the U.S. that they're aware of what we do, and the necessity of filing U.S. and/or Canadian tax returns, depending on which side of the border you're coming from. So those two items alone have basically been able to drive what we do, and be able to facilitate cross-border taxpayers in their tax compliance, and for such a long time. So that's been where a lot of it has come from.
Well, I have to say, I've always been impressed. We've had many opportunities to work back and forth with clients in need of cross-border solutions and problems they're dealing with. So I really appreciate you two being on the show today. I hope that our listeners, it's very easy to get a hold of Tony and Cindy. It's CompassTAX. They're based out of Calgary. They're about 25-minute walking distance from the, I want to call it the Saddle Dome. It's still called the Saddle Dome, isn't it, in Calgary?
Yeah, still a Saddle Dome. Some people will still refer to it as Scotia Bank Saddle Dome, not to give them a club, but
Okay.
the name on the building.
Okay. But anyhow, thank you very much for being on the show. And I always tell people, the world is small. Be kind to all. Enjoy your afternoon.
Thanks for having us.